story behind stocks. We don't just follow the stock price. We follow the story behind the stock. This is not simply a story about mining machines. It is a story about whether a 51-year-old industrial company can reinvent its economic identity. We then ask whether diversification can become sustained growth before arriving at the most important moment of the story, the possible inflection point where orders, revenue, margins, cash flow, and returns could begin moving together. After that comes the financial transformation, the dramatic improvement in margins, followed by the uncomfortable question, where's the order book acceleration? Then we examine the legacy business, the transition into metal mining and construction, and the technology capability behind the new products. First, we go back to the beginning, how a pioneer built its identity in one of India's toughest industries. In the chapters ahead, we will follow Eimco Elecon through 8 turning points. Before we begin, Chapter 1, the machine that started it all. Long before mining equipment became a story about automation, technology, and rising capital expenditure, there was a company quietly building machines for one of India's toughest industries. Its name was Eimco Elecon. The company was incorporated in 1974 as a joint venture with Eimco, UK, with a very specific purpose: to enter the underground coal mining equipment business in India. At that time, underground mining was not a simple business. The environment was difficult. The machines had to work underground in harsh conditions where reliability was not a luxury. A machine failure could mean lost production, lost time, and serious operational problems. This is where Eimco Elecon began building its identity. Not as a company trying to sell ordinary industrial machines, but as a company trying to solve a very specialized problem. The company says it was the first in India to introduce equipment for semi-mechanized underground coal mining. Over the years, that experience helped it establish a leadership position in Indian underground mining equipment. And this is the first important part of the Eimco story. It was there early, very early. For more than 5 decades, the company has remained connected with the mining industry. 51 years of experience may sound like just another number in an investor presentation. But for a specialized engineering company, experience can become an asset. Because mining equipment is not only about manufacturing steel and assembling components. It requires understanding the mine, understanding the customer, understanding how the equipment behaves underground, understanding what fails, understanding what the operator needs, and most importantly, understanding how to make the next machine better than the previous one. That knowledge is difficult to build overnight. Eimco's journey shows this gradual evolution. The company started with pneumatic loaders. Then came STLs and LHDs. Later, it expanded into underground drilling and utility equipment. It introduced larger load haul dump machines. It entered newer applications. And over time, its product portfolio moved beyond its original equipment categories. This is where the story starts becoming more interesting. Because Eimco was not simply preserving an old business. It was slowly adding new capabilities around its original mining expertise. The company launched a piling rig in collaboration with CZM of the USA. It developed a continuous miner package. It introduced a 7-ton LHD for metal mines. It launched a feeder breaker. And it expanded its equipment offering for underground metal mining and construction. So the company that once built its identity around underground coal mining equipment was gradually becoming something broader. That evolution matters, because the future opportunity may not come only from the same market that created the company. The company now has equipment for underground coal mines. It has equipment for underground metal mines. And it has entered the construction equipment segment. This gives the Eimco story a very different angle. The question is no longer simply, how much can India's underground coal mining grow? The bigger question becomes, how large can Eimco become if its engineering experience can be transferred into multiple mining and construction applications? there is another piece of this story that is easy to miss. Technology. Eimco has an in-house R&D facility approved by the SEER, with a team of more than 50 engineers dedicated to research and development. That tells us something about the company's ambition. It does not want to remain only a manufacturer of legacy mining equipment. It wants to design, analyze, and develop equipment internally. The R&D process shown by the company moves through pre-design, engineering, design analysis, and value engineering, followed by 3D modeling and drawings. In other words, the company is trying to move further up the engineering value chain. And this is important because specialized industrial businesses can become stronger when their knowledge is embedded not just in their factory, but in their engineering capabilities. There's also a long list of customers connected with the mining ecosystem. Names such as Tata Steel, SCCL, Hindustan Zinc, USIL, and others appear in the company's presentation. These relationships matter because industrial equipment is rarely bought simply because a machine looks attractive. Customers need reliability. They need service. They need spare parts. They need confidence that the manufacturer will remain available long after the machine leaves the factory. Eimco has built a national sales and service network covering important mining centers across India. So the company's historical advantage is not one single product. It is the combination of experience, engineering knowledge, products, customers, and service capability. That is the real power of being a pioneer. But there is an important twist. Being first does not automatically make a company the future winner. A pioneer can also become trapped by its own history. The market can change. Technology can change. Customers can change. And competitors can catch up. So after 51 years, the most important question for Eimco is not whether it was a pioneer. We already know it was. The real question is, can the pioneer reinvent itself? Can a company built around underground coal mining become a broader mining technology platform? Can its expertise move from coal into metal mining? Can construction become a meaningful second engine? Can newer products create a larger opportunity? And can all of this eventually produce faster revenue growth and stronger returns on capital? That is where the Eimco story changes. Because the first chapter is about the past. The next chapter is about transition. And that transition may decide whether Eimco remains a respected niche engineering company or becomes a much larger story in India's mining and infrastructure equipment cycle. Story behind stocks. The past built the moat. The future must prove it. Chapter 2. The Legacy Engine. For more than 5 decades, Eimco Elecon built its identity around one difficult market, underground mining. And within that market, underground coal mining became an important part of the company's story. The business was born in 1974 as a joint venture with Eimco, UK, specifically to enter underground coal mining equipment in India. That original focus shaped almost everything that came after. The machines had to work in an environment where conditions were difficult, space was restricted, and reliability mattered enormously. Eimco developed equipment such as pneumatic loaders, SDLs, LHDs, and UDMs for underground mining. These were not consumer products. A mining company does not replace equipment because it wants something new. It buys equipment because the machine has to perform a very specific job, moving material, loading ore or coal, drilling, supporting operations, or improving productivity underground. That created an important relationship between Eimco and its customers. The company was not simply selling machines. It was becoming part of the mining operation. Over the years, Eimco established a presence across India's major mining regions, with sales, service, and spares facilities in places such as Asansol, Dhanbad, Jamshedpur, Kolkata, Manendragarh, Nagpur, and Ramagundam. That network became part of the old business model. Sell the machine, support the machine, supply the spares, service the machine, and remain connected to the customer. This kind of business can create relationships that are difficult for a new entrant to build quickly. But there was another side to the old Eimco story. The business was relatively small, and the opportunity was closely connected to the mining investment cycle. When mining companies invest in new capacity, equipment manufacturers can benefit. When investment slows, equipment demand can become uneven. That cyclicality is important when looking at Eimco's historical numbers. The company's revenue did not move in a straight line. There were years of strong business and years when revenue contracted sharply. For example, sales were around 196 crore rupees in FY15. They subsequently fell to 108 crore rupees by FY20. Then the business began recovering. FY23 sales reached 173 crore rupees. FY24 reached 228 crore rupees. FY25 reached 246 crore rupees. So the old business had already demonstrated that it could recover strongly when conditions improved. But something even more important happened during that recovery. Profitability improved much faster than revenue. From FY23 to FY25, revenue increased from 173 crore rupees to 246 crore rupees. That is meaningful growth. But EBITDA increased from 24 crore rupees to 56 crore rupees. And EBITDA margin moved from 14.1% to 17.6% and then to 22.8%. This tells us that Eimco was not simply selling more machines. It was generating considerably more operating profit from its business. That is where the old business begins to reveal a hidden strength. The company had engineering capability and an established product portfolio. When business conditions improved, operating leverage began to appear. But there was still a limitation. The old Eimco model was heavily associated with its traditional mining identity, and that created a natural ceiling. If the company remained primarily an underground coal equipment manufacturer, its growth opportunity would always be linked to that particular market. That is why the company's product evolution becomes so important. The company started adding equipment for underground metal mines. It introduced larger LHDs. It developed newer mining systems. It launched the continuous miner package. It added the feeder breaker. And eventually it entered the construction equipment segment with piling equipment. These developments were not just new products appearing in a catalog. They represented an attempt to change the economic identity of the company. Because there is a big difference between saying, we make underground coal mining equipment, and saying, we are an engineering company serving multiple mining and infrastructure applications. The second business has a much larger possible addressable market. But transition does not happen simply because management launches products. The new products have to generate orders. Orders have to become revenue. Revenue has to become profit. And profit has to become cash. That is where investors need to be careful. The old Eimco business had already shown margin improvement, but the next phase required something different. It required growth visibility. And this is where the company's numbers started raising an important question. In the Q1 FY26 investor presentation, the open order position at 30th June 2025 was shown at only 39 crore rupees compared with 125 crore rupees a year earlier. That was a significant decline. So while the company was developing a broader product portfolio, the immediate order visibility was not yet supporting a simple acceleration story. This creates an interesting contradiction. On one side, better margins, new products, R&D capability, and broader markets. On the other, limited order book visibility and uneven revenue growth. And this contradiction is exactly what makes Eimco interesting. Because the investment case is no longer about what Eimco has been. It is about what Eimco can become. The old business gave the company something extremely valuable. A foundation, decades of mining experience, established customers, service infrastructure, manufacturing capability, engineering knowledge, and a reputation in underground mining. But a foundation is not the building. The company now has to use that foundation to construct something larger. That is why the old Eimco story should not be dismissed as a slow, traditional industrial business. It may actually be the starting point of a much bigger transition. The pioneer had learned how to build mining machines. Now it had to learn how to build a broader business around them. And that is where the story begins to move from the old Eimco to the new Eimco. Story behind stocks, when a niche company starts chasing a bigger destiny. Till now we have heard about the old Eimco business created a strong foundation. Decades of mining experience, customer relationships, service infrastructure, and improving profitability. But the same legacy also created a ceiling because the company remained closely tied to a specialized mining market. The next question is whether Eimco can use that foundation to build something much larger. Now we move from the legacy engine to the great transition. Coal to metal mining, mining to construction, machines to broader solutions, and the capability needed to support that shift. Chapter 3. The Great Transition. For decades, Eimco Elecon was known for one thing: underground mining equipment. That was its strength. But it could also become its limitation. Because a company can dominate a niche and still remain a small company if the niche itself does not expand fast enough. And this is where the Eimco story begins to change. The company starts moving from a traditional underground coal equipment manufacturer towards something much broader. Not through one dramatic announcement, but through a series of small steps. New products, new mining applications, new customers, new engineering capabilities, and eventually, new markets. The first important change was the move beyond its traditional underground coal equipment portfolio. Eimco began developing products for underground metal mines. The company now offers 3-ton, 7-ton, and 10-ton load haul dump machines, along with drilling equipment for metal mining applications. That matters because coal and metal mining may use similar principles, but the equipment requirements and operating environments can be different. So Eimco was taking something it already understood, underground mining, and applying that knowledge to another market. This is the first layer of the transition: coal to metal mining. But management was not stopping there. The company also entered the construction equipment business. Its product portfolio includes piling equipment such as the EC-125, EC-216, and EC-267. This changes the potential story, because now Eimco is no longer dependent only on underground mining. It has another market where its engineering and manufacturing capabilities can potentially be used. So the transition becomes coal mining to metal mining to construction equipment. And there is another transition happening underneath all of this: the transition from individual machines to broader mining solutions. Look at the continuous miner package. Instead of presenting one machine in isolation, Eimco's package brings together a continuous miner, roof bolter, shuttle car, and feeder breaker. That is a very different proposition. The company is attempting to participate in a larger part of the mining workflow, and that can potentially create a deeper relationship with the customer. The transition is therefore not simply about adding products. It is about increasing the number of problems Eimco can solve for a mining customer. And that is where the company's engineering capability becomes important. Eimco has a DASIR-approved in-house R&D facility with more than 50 engineers. The presentation describes capabilities covering pre-design, engineering, design analysis, value engineering, and 3-D modeling. This tells us that the company is trying to build its future around engineering capability rather than simply manufacturing legacy products. That distinction matters. A traditional manufacturer asks, "What machine can we sell?" A technology-oriented engineering company increasingly asks, "What problem can we solve?" That is the direction Eimco appears to be moving toward. But there is another important development in the company's journey. In 2025, the presentation records the termination of the JV agreement. The original company itself had been incorporated in 1974 as a joint venture with Eimco, UK, to enter India's underground coal mining equipment market. So more than 5 decades later, the company was entering another phase of its corporate journey. The old relationship that helped establish the business was coming to an end. The significance is not simply corporate restructuring. For the investor, it represents a symbolic point in the story. The company that began with a foreign technology partnership had spent decades building its own products, engineering capability, and market presence. Now the question becomes, can that accumulated capability support the next phase independently? That is a much more interesting question than simply asking whether the company has launched another product. And the financial numbers give us one early clue. Between FY23 and FY25, revenue increased from 173 crore rupees to 246 crore rupees. But EBITDA increased from 24 crore rupees to 56 crore rupees. EBITDA margin moved from 14.1% to 22.8%. PAT increased from 21 crore rupees to 49 crore rupees. The investor presentation shows EBITDA growing at a 52% CAGR and PAT at a 53.1% CAGR across FY23, FY25. So something had already started changing inside the economics of the business. The company was generating considerably more profit from its revenue base. That is the encouraging side of the transition. But every transition has a test. And Eimco's test is scale. A company can have new products. It can enter new markets. It can improve margins. But eventually the market asks one simple question. Where's the revenue growth? And this is where investors need to look carefully. The Q1 FY26 presentation showed revenue of 68 crore rupees, compared with 70 crore rupees in Q1 FY25. EBITDA fell from 15 crore rupees to 12 crore rupees. The EBITDA margin declined from 21.6% to 18.2%. PAT was 14 crore rupees compared with 15 crore rupees a year earlier. More concerning was the open order position. At 30th June 2025, open orders were shown at only 39 crore rupees, compared with 125 crore rupees a year earlier. That was a decline of almost 69%. So the transition was visible in the product portfolio. It was visible in the engineering capability. It was visible in the historical margin expansion. But it was not yet fully visible in the forward order visibility. And this is the central tension in the Eimco story. The company looks like
the numbers
it is becoming
still need to
something
prove
new, that the new business can become large enough to materially change the company's growth trajectory. This is why I would not call Eimco an acceleration story yet. I would call it a transition story waiting for confirmation. The transition has 3 major dimensions. First, market transition. From underground coal toward metal mining and construction. Second, product transition. From individual machines toward broader mining equipment packages and solutions. Third, capability transition. From a legacy equipment manufacturer toward a more engineering and R&D driven company. And there's potentially a fourth transition. Financial transition. If the new products and markets begin generating larger orders, then the company's existing manufacturing base and improved margins could create operating leverage. That is where the story could become much more powerful. Imagine the sequence. More orders. Then a stronger order book. Then higher revenue. Then the existing manufacturing base absorbs more volume. Then margins remain healthy. Then profits grow faster than sales. Then ROCE improves. And finally, the market begins to value Eimco not as a small traditional mining equipment company, but as a specialized industrial growth company. But that sequence is still a possibility. It is not yet a proven fact. And that distinction is critical for an investor. Because the market does not pay for a transition simply because management talks about it. The market eventually pays for evidence that the transition is working. That evidence will come through orders, through revenue, through margins, through cash flow, and through returns on capital. So the real story of Eimco is beginning to shift. The old Eimco was built around underground coal mining. The emerging Eimco is trying to build a much wider platform. Coal, metal mining, construction, new equipment, engineering, R&D. But the most important question is still ahead. Can all these pieces come together and create a business that grows faster than the Eimco of the past? Because if they can, then this is not simply a company adding products. It is a company changing its identity. And that is what makes the transition worth watching. The old Eimco built machines for the mining industry. The new Eimco is trying to build a larger business around its engineering expertise. The next chapter is about the technology that could make that transition possible. Story behind stocks. The real upgrade is not the machine. It is the capability behind it. In this chapter, we learned that Eimco is changing its product and market identity, moving beyond underground coal into metal mining, construction, and broader equipment packages. The historical financial improvement makes the transition interesting, but the Q1 FY26 numbers show that the transformation has not yet become a proven growth acceleration. Now we will look beneath the machines and into the technology upgrade, the R&D capability, engineering depth, and product development engine that could make the transition scalable. Chapter 4: Beyond the Machine. The easiest way to misunderstand Eimco Elecon is to look only at the machines. The yellow machines, the loaders, the drills, the mining equipment working deep underground. Because behind those machines, something less visible has been changing. The technology capability of the company. And this could become one of the most important parts of the Eimco transition story. For decades, Eimco's reputation was built on manufacturing specialized mining equipment. But manufacturing a machine and engineering a machine are two different things. Manufacturing is about producing efficiently. Engineering is about understanding the problem before the machine is even built. And Eimco has been building that engineering capability. The company has a DASIR-approved in-house R&D facility with a team of more than 50 engineers dedicated to research and development. That number is important in the context of a company of Eimco's size. It suggests that R&D is not being treated simply as a support function. It is becoming part of the company's product development process. The company's presentation shows a development process beginning with the pre-design stage. Then comes engineering. Then design analysis and value engineering. Then three-dimensional modeling and drawings. In simple words, the company is trying to understand the machine before it reaches the factory floor. That matters in mining, because underground equipment operates in environments where reliability, productivity, and suitability are critical. A machine cannot simply be designed for showroom. It has to work where conditions are difficult. It has to fit the mining environment, and it has to perform the job expected from it. This is where decades of mining experience can combine with engineering capability. The old Eimco had something valuable: knowledge of the customer and the mining environment. The technology upgrade attempts to add another layer: the ability to design and develop more sophisticated solutions around that knowledge. And we can see this evolution in the product portfolio. Take the continuous miner package. It is not just one machine. The company presents a package consisting of a continuous miner, roof bolter, shuttle car, and feeder breaker. That is significant because the company is moving toward a broader equipment solution. Instead of asking, can we manufacture one machine? The opportunity becomes, can we participate in more stages of the mining process? That can potentially increase the value of each customer relationship. The same evolution can be seen in metal mining. Eimco has developed equipment including 3-ton, 7-ton, and 10-ton LHDs, as well as drilling equipment for underground metal mines. This is important because the company is applying its engineering knowledge beyond its traditional underground coal equipment base. Then comes construction. Eimco's construction portfolio includes piling equipment such as the EC125, EC216, and EC267. So technology is helping enable the wider transition. Coal mining equipment, metal mining equipment, construction equipment. The company is taking its engineering capability into different applications. But there is another part of the technology story that is easy to overlook. The company's evolution has taken place over decades. Its product journey includes pneumatic loaders, SDLs and LHDs, UDMs, CLMRS, larger LHDs, piling rigs, continuous minor packages and feeder breakers. That means the technology upgrade is not a sudden transformation. It is a gradual accumulation of engineering knowledge. Every new product adds another piece. Every new application creates another learning opportunity. And every successful product can potentially increase the company's addressable market. This is where the technology story connects with the financial story. Between FY23 and FY25, Eimco's EBITDA increased from 24 crore rupees to 56 crore rupees. EBITDA margin improved from 14.1% to 22.8%. PAT increased from 21 crore rupees to 49 crore rupees. The company's presentation shows EBITDA growing at a 52% CAGR and PAT at a 53.1% CAGR over this period. We cannot say that all of this improvement was caused by R&D. The presentation does not make that claim. But the numbers do show that the company's economics improved significantly while its product and engineering capabilities were expanding. And this is where investors need to distinguish between technology as a story and technology as a business advantage. A company can spend money on R&D and still fail to create value. The real test is whether R&D produces better products, new customers, new markets, larger orders, higher margins, and eventually, better returns on capital. That is the test Eimco still has to pass. And there is one particularly important warning sign. Despite the product expansion and engineering capability, the Q1 FY26 investor presentation showed open orders of only 39 crore rupees, compared with 125 crore rupees a year earlier. That tells us something very important. The technology upgrade is visible. The product expansion is visible. The historical margin improvement is visible. But the conversion of this capability into a strong forward order pipeline still needs proof. This is why the technology story should not be presented as Eimco has technology, therefore growth is guaranteed. That would be too simple. The better story is Eimco has spent years building engineering capability. Now the market has to see whether that capability can create a larger business. And that brings us back to the transition. The company started as an underground coal equipment player. It became a broader mining equipment manufacturer. It moved into metal mining. It entered construction equipment. It developed more integrated mining packages. And behind all of this sits an R&D organization capable of designing and developing equipment internally. That is the technology upgrade. But the next upgrade has nothing to do with machines. It is the upgrade investors care about most. Can technology become growth? Can engineering capability become orders? Can orders become revenue? Can revenue become operating leverage? Can operating leverage become higher earnings? And can higher earnings ultimately produce stronger returns on capital? If that chain starts working consistently, then Eimco's transition becomes much more than a product story. It becomes a business model story. The company would no longer be valued only for what it manufactured in the past. It could begin to be valued for what its engineering platform can create in the future. And that is the real technology upgrade. Not simply building better machines. Building a business capable of creating better economics from those machines. The machines are visible. The R&D team is visible. The product evolution is visible. But the biggest question is still invisible. How much growth can all this technology ultimately unlock? That answer will come from the next chapter. The margin transformation. Story behind stocks. Revenue tells you how big. Margins tell you how powerful. Till now we have heard about Eimco's technology story is really an engineering capability story. Its R&D organization, product development, and broader solutions show a company trying to move up the value chain. But technology only matters financially when it produces customers, orders, revenue, and returns. The next question is financial. What happened when Eimco's business began generating much more profit from each rupee of revenue? Chapter 5. When profitability changed the story. There's a point in every business story where revenue stops telling the full story. Eimco Elecon reached that point. For years, investors could look at the company and see a relatively small mining equipment manufacturer. But something changed underneath the revenue numbers. The company started making more profit from every rupee of sales. And that is where the Eimco story becomes much more interesting. Look at the progression. In FY23, Eimco reported revenue of about 173 crore rupees. EBITDA was around 24 crore rupees. The EBITDA margin was only 14.1%. Then came FY24. Revenue increased to approximately 228 crore rupees. EBITDA moved to 40 crore rupees. And EBITDA margin improved to 17.6%. Then came FY25. Revenue reached 246 crore rupees. But EBITDA reached 56 crore rupees. The EBITDA margin climbed to an impressive 22.8%. The company's investor presentation shows EBITDA growing at a 52% CAGR between FY23 and FY25, while PAT grew at a 53.1% CAGR. This is the margin transformation. And it is more important than simply saying, Eimco's profits grew. Because profit growth can come from many things. A company can sell more products. It can increase prices. It can reduce costs. It can change its product mix. Or it can become more efficient. In Eimco's case, the numbers show that profitability improved dramatically relative to revenue. Revenue increased by roughly 42% from FY23 to FY25. But EBITDA increased by more than 130%. That is operating leverage. The business was becoming significantly more profitable as it scaled. And this is where the transition story gets another layer. The first transition was about what Eimco sells. The second was about where it sells. The margin transformation tells us something about how economically attractive the business can become. The gross profit margin also improved. It moved from around 44% in FY23 to 45.9% in FY24 and then to 53.8% in FY25. That is a substantial change. At the same time, EBIT margin moved from 15.6% in FY23 to 22.4% in FY24 and 26.8% in FY25. PAT margin moved from 12.1% to 17.8% and then 19.8%. So this was not simply an EBITDA improvement. Profitability improved at multiple levels. And that raises an important question. Why does margin expansion matter so much for an investor? Because when a company has a relatively fixed manufacturing and engineering base, additional revenue can sometimes produce disproportionately higher profits. Imagine a factory that is capable of producing more equipment than it currently produces. The factory already exists. The engineers already exist. The engineers already exist. The service network already exists. Many overhead costs are already being incurred. If revenue increases while the cost base does not rise at the same pace, the additional revenue can flow through to operating profit at a higher rate. That is the power of operating leverage. And Eimco's FY23 to FY25 numbers suggest that this phenomenon had started appearing. But there is an important warning. Margin expansion is not the same thing as permanent margin expansion. An investor should never assume that a 22.8% EBITDA margin automatically becomes the new normal. The business has to prove that it can maintain those margins through different phases of the cycle. And the very next year provides that test. In Q1 FY26, revenue was around 68 crore rupees, compared with 70 crore rupees in Q1 FY25. EBITDA fell from 15 crore rupees to 12 crore rupees. The EBITDA margin declined from 21.6% to 18.2%. PAT was 14 crore rupees compared with 15 crore rupees in the previous year quarter. So the margin transformation did not continue in a straight line. That is extremely important, because this is where an investor must separate the historical transformation from the future expectation. Historical evidence says Eimco can generate much higher margins than it did a few years ago. But current evidence says those margins can fluctuate, and that makes the next phase of the story much more interesting. The question is no longer, can Eimco improve margins? It already has. The question becomes, can Eimco maintain high margins while simultaneously accelerating revenue? That combination would be much more powerful. Imagine two scenarios. In the first scenario, revenue grows slowly and EBITDA margin remains around 18-20%. The company becomes more profitable, but growth remains moderate. That would support a decent industrial business. In the second scenario, revenue starts accelerating because new mining and construction opportunities begin contributing. At the same time, EBITDA margin remains around 20% or higher. Then the economics change. Revenue growth could combine with operating leverage. That could make earnings grow considerably faster than revenue. And that is the point at which the market may begin to look at Eimco differently. But there's another metric that needs attention. ROAS. Because high margins alone do not guarantee a high-quality business. A company can have attractive margins and still generate poor returns if too much capital is tied up in the business. Eimco's investor presentation showed ROAS improving from approximately 7.8% in FY23 to 13.6% in FY24 and 16% in FY25. That improvement is encouraging. But the latest numbers you provided show ROAS around 10.3%, suggesting that the improvement has not yet become a permanently higher return profile. And this is where working capital becomes important. Eimco's business has significant capital tied up in inventory and receivables. So the next level of transformation cannot simply be higher EBITDA margin. It has to become higher margin plus better asset utilization plus better cash conversion. That would create a much stronger business. There is also an important difference between accounting profit and cash. In FY25, Eimco generated around 33 crore rupees of cash from operations against PAT of roughly 49 crore rupees. That is not a reason to dismiss the company. But it is a reason to keep watching cash conversion. Because eventually, a strong industrial business must turn its profits into cash. That is the next test of the transformation. So when we step back, the Eimco story now has three layers. First, the pioneer, a company with decades of specialized mining experience. Second, the transition, a company expanding from traditional underground coal equipment into metal mining, construction, and broader mining solutions. Third, the margin transformation, a company that demonstrated the ability to dramatically improve profitability as its business scaled. But the story is still incomplete, because the market does not ultimately reward a company for having achieved a high margin once. It rewards a company when high margins become repeatable while revenue continues to grow. And that is where Eimco reaches its next challenge. The company needs more orders. It needs stronger revenue visibility. It needs to maintain its improved margins. And it needs to convert those profits into cash. The Q1 FY26 presentation makes this challenge particularly visible. Open orders at 30th June 2025 were only 39 crore rupees compared with 125 crore rupees a year earlier. So the market has a very simple question to answer. Was the FY23, FY25 margin expansion the beginning of a new business model? Or was it partly the result of a particularly favorable phase in the cycle? The next few quarters will provide the evidence. If revenue accelerates and margins remain strong, the old mining equipment company could begin to look like an earnings growth company. If revenue remains uneven and margins retreat, the market may treat the previous margin expansion as cyclical. And that is why the margin story is so important. The transformation has already happened in the profit and loss statement. Now it has to prove itself in the future. Because the ultimate version of the Eimco story is not a small company that improved its margins. It is a specialized engineering company that discovered operating leverage and then used it to build a much larger business. That is the opportunity. But it is also the risk. And the next chapter will take us to the biggest question of all. Where will the next growth actually come from? Story behind stocks. Every growth story eventually meets the order book. In this chapter, we learnt about from FY23 to FY25, Eimco's margins and profits improved dramatically, showing operating leverage and a potentially stronger economic model. But Q1 FY26 reminded investors that high margins are not automatically permanent. The bigger opportunity is high margins combined with accelerating revenue and stronger cash conversion. Now comes the uncomfortable part of the story, the 125 rupee crore question. If the company is transforming, where's the order book acceleration? And that is the risk. So this 125 crore rupees to 39 crore rupees number should not be treated simply as a negative statistic. It is a question mark over the future. And sometimes the most important part of an investment story is not the answer. It is the question that investors must keep watching. For Eimco, that question is simple. Where is the next 100 crore rupees of orders going to come from? From coal? From metal mining? From construction? From new mining packages? From existing customers buying more equipment? Or from completely new customers and markets? The answer could determine whether the transition becomes an acceleration. And that is why the next chapter is critical. Because if the order book starts moving again, something very interesting could happen. The same operating leverage that transformed Eimco's margins could begin transforming its earnings. That is the potential. But first, the orders have to arrive. Story behind stocks. A new product is a promise. An order is proof. In this chapter, we learned that the fall in open orders from 125 crore rupees to 39 crore rupees in the Q1 FY26 presentation creates the central question mark over the investment thesis. Products, margins, and capabilities are visible, but future revenue visibility still needs proof. The missing bridge is orders becoming sustained execution. We now ask whether Eimco's diversification is merely a wider catalog, or whether these new products can become a genuine economic growth engine. Chapter 7. Diversification. Story or scale? At this point in the Eimco Elecon story, the question becomes much bigger than mining equipment. The company has already shown that it can evolve. It has expanded its product portfolio. It has entered underground metal mining. It has moved into construction equipment. It has developed a continuous miner package. It has built an in-house R&D capability. And between FY23 and FY25, its revenue increased from 173 crore rupees to 246 crore rupees, while EBITDA increased from 24 crore rupees to 56 crore rupees. EBITDA margin moved from 14.1% to 22.8%. So the diversification story is real. But an investor cannot stop there, because more products do not automatically mean more revenue. That is the central question. Can product diversification become sustained growth? This is where the Eimco story moves from strategy to execution. Imagine the company as it was years ago. One major identity: underground coal mining equipment. The opportunity was relatively concentrated. Now the company has a much broader product map. Underground coal, underground metal mining, construction equipment, continuous miner packages, roof bolters, shuttle cars, feeder breakers, LHDs, piling equipment. On paper, that looks like a much larger opportunity. But the investor needs to see something very simple. Are these new products actually creating incremental business? Because there are two very different types of diversification. The first type is catalog diversification. A company launches new products, adds them to its website and presentations, and says it has entered a new market. The second type is economic diversification. The new products generate orders. Those orders generate revenue. That revenue becomes a meaningful part of the business. That is the transition investors are waiting to see from Eimco. And the company's product journey provides some encouraging evidence. The company has gradually moved from traditional underground mining equipment toward a wider range of machines and packages. Its evolution includes the 7-tone LHD for metal mines, the continuous miner package, feeder breaker, and construction equipment. So the strategic direction is clear. But strategy is only the first half of the story. The second half is scale. And this is where Eimco still has something to prove. The Q1 FY26 investor presentation showed open orders of 39 crore rupees at 30th June 2025, compared with 125 crore rupees a year earlier. That number creates an uncomfortable contradiction. The company is becoming more diversified, but the visible order pipeline at that point had actually become smaller. That does not mean the diversification has failed. It means the market does not yet have enough evidence to conclude that diversification has become sustained growth. And that distinction is critical, because an investor should not pay for future diversification simply because it sounds attractive. The investor should wait for the economic evidence. That evidence can appear in several places. First, revenue mix. If metal mining and construction become meaningful contributors, the company's dependence on its traditional business should decline. Second, order inflow. New products should start generating incremental orders rather than simply replacing old products. Third, revenue growth. The new businesses should help push the company's overall revenue growth higher. Fourth, margins. The additional business should not destroy the profitability improvement that Eimco has already achieved. And fifth, cash flow. Growth should eventually produce cash rather than simply increasing inventory and receivables. This last point is particularly important. A company can report strong revenue growth while cash remains trapped in working capital. For Eimco, therefore, the ideal transition is not simply more products to more sales. It is more products, more orders, higher revenue, healthy margins, stronger cash flow, better ROEs. That is the complete transformation. And there is a reason to believe the company has some of the ingredients required. It has manufacturing facilities. It has a national sales and service network. It has an R&D center with more than 50 engineers. It has decades of mining experience. And it has already demonstrated that profitability can improve significantly as the business scales. But ingredients are not results. That is why this remains an investor question rather than an investor conclusion. There's also an important difference between entering a new market and winning a new market. Eimco has entered construction equipment, but the presentation does not provide enough information in the supplied material to conclude that construction has already become a major revenue engine. Similarly, Eimco has expanded into underground metal mining. But again, the supplied presentation does not provide a detailed revenue split that allows us to say that metal mining has already transformed the company's financial profile. So we should not overstate the transition. The opportunity is visible. The commercial scale is still developing, and that makes the next few quarters particularly important. Suppose order inflows start increasing. Suppose the order book recovers from the low level shown in Q1 FY26. Suppose metal mining and construction contribute more meaningfully. Suppose revenue moves from a roughly 240 crore rupees annualized base toward a much higher level. And suppose EBITDA margins remain around the high teens or 20% range. Then something changes. Eimco's diversification would no longer be a presentation slide. It would become an earnings engine. And that could be the point at which the market starts rewarding the company differently. But there is an equally important opposite scenario. If the new products remain small, if order inflows remain inconsistent, if revenue growth remains modest, and if working capital continues consuming cash, then diversification may remain strategically attractive without creating a major financial transformation. That is the risk. So the investor question is not, does Eimco have new products? The answer is clearly yes. The better question is, are the new products large enough to change the company's growth trajectory? That is the question the market needs answered. And perhaps the most useful way to think about Eimco today is this. The company has already crossed the first bridge, from legacy products to a broader portfolio. It is now standing on the second bridge, from product diversification to commercial scale. The next bridge will be even more important, from commercial scale to earnings acceleration. If Eimco can cross all three, the investment story becomes powerful. Because then the company's history, technology, product diversification, and operating leverage all begin working together. The pioneer provides the foundation. The technology provides the capability. The diversification provides the opportunity. The margins provide the economics. But orders provide the proof. And that is why the next stage of the Eimco story should not be judged by how many machines the company can manufacture. It should be judged by how many customers are willing to buy them. Because ultimately, diversification only matters when it becomes growth. And growth only matters when it becomes profitable, cash-generating growth. That is the transformation the investor is waiting to see. Can Eimco turn a wider product portfolio into a wider revenue base? And if it can that wider revenue base become the acceleration the market is currently waiting for? Story behind stocks. When transition becomes acceleration, the market starts listening. In Chapter 7 we learned, Eimco has clearly diversified its product and market opportunity. But diversification only becomes valuable when it creates incremental orders, revenue, profit, and cash. The company has crossed the bridge from legacy products to a broader portfolio. Commercial scale is the next bridge. Finally, we arrive at the moment of truth. What could happen if orders recover while the improved margin structure remains intact? Chapter 8. The moment of truth. Every transition story eventually reaches a moment when the market has to decide. Is this simply a company with a promising new direction? Or is it the beginning of a completely different earnings trajectory? For Eimco Elecon, that moment could come from one place: orders. The company has already built many of the ingredients. It has more than 5 decades of mining experience. It has expanded beyond its traditional underground coal equipment business. It has entered underground metal mining. It has entered construction equipment. It has developed larger and more specialized mining products. It has built an in-house R&D capability with more than 50 engineers. And it has demonstrated that profitability can improve sharply when the business scales. But all of these pieces are still waiting to connect. That connection is the inflection point. What happens if orders accelerate? Imagine Eimco's order pipeline starts recovering. The first effect would be increased revenue visibility. The company would have greater confidence about future production. Factories could operate at higher utilization. The existing engineering and manufacturing infrastructure could support more volume. And this is where the earlier margin transformation becomes important. Eimco has already shown that EBITDA margin can move from 14.1% in FY23 to 22.8% in FY25. If higher volumes arrive while margins remain healthy, the economics could become much more powerful. Because the company would not simply be selling more. It could potentially be earning more from each additional rupee of revenue. That is operating leverage. And this is where a transition story can become an acceleration story. The sequence would look something like this: new products, more customer acceptance, higher order inflow, order book recovery, revenue acceleration, high operating margins, faster profit growth, higher cash generation, improved ROEs. That is the chain investors need to see. But there is an important condition. The margins must remain high, because revenue growth alone is not enough. Suppose orders increase by 30%, but margins collapse because of higher costs, competition, or an unfavorable product mix. The earnings impact could be much smaller than expected. But if revenue increases while EBITDA margins remain around the high teens or move toward the stronger levels seen in FY25, the operating leverage could be significant. That is why the combination matters. Orders plus margins, not orders alone, and not margins alone. This is also why Eimco's Q1 FY26 numbers are worth remembering. Revenue was 68 crore rupees. EBITDA was 12 crore rupees. EBITDA margin was 18.2%. PAT was 14 crore rupees. The business was still profitable. The margin was still respectable. But the quarter did not demonstrate a clear acceleration. So the inflection point has not been confirmed in the supplied presentation. It remains a possibility. And there's another important number. The open order position at 30th June 2025 was 39 crore rupees, compared with 125 crore rupees a year earlier. This is why the order book recovery is so important. The market needs to see that the 39 crore rupees number was not the beginning of a prolonged slowdown. It needs to see new orders replacing the executed backlog. It needs to see the order pipeline rebuild. And ideally, it needs to see the new businesses contributing to that recovery. That would be the strongest confirmation of the transition. Imagine a future where the order book starts rising because customers are increasingly buying metal mining equipment, larger LHDs, continuous miner packages, feeder breakers, and construction equipment. Then the diversification story changes character. It is no longer Eimco has diversified. It becomes Eimco's diversification is generating orders. That is a much more valuable statement for an investor. And then comes the next question. Can the company execute? Because winning an order is only the beginning. Eimco needs to manufacture the equipment, deliver it, service it, collect the money, and manage working capital. This is particularly important because the company has historically carried significant working capital. So a genuine inflection point should ideally show up in more than the order book. It should eventually appear in revenue growth, EBITDA growth, cash flow, ROEs. The best version of the Eimco story is therefore not simply an order book recovery. It is a quality growth cycle. More orders, better utilization, strong margins, higher profits, better cash conversion, higher returns, and potentially a higher valuation. This is where the stock could transition from being valued as a small specialized industrial company toward being valued as a specialized growth company. But investors should also understand the other side. If orders do not accelerate, the transition may take much longer. If margins fall materially, operating leverage may not appear. If working capital remains high, profit growth may not translate into cash. And if the new businesses remain too small, diversification may not materially change the company's economics. So the inflection point is not guaranteed. It is a testable thesis. That is what makes it useful for an investor. You don't have to predict the future. You can watch the evidence. The evidence should come in stages. First, are orders increasing? Then, is the order book rebuilding? Then, is revenue accelerating? Then, are margins holding? Then, is cash flow improving? And finally, is ROEs moving higher? If the answer becomes yes across these stages, the market may begin to recognize something that was previously only a possibility. Eimco may no longer be simply a company in transition. It may be entering an earnings acceleration phase. And that would change the story completely. The old Eimco was built around a specialized mining equipment business. The emerging Eimco has a broader product portfolio. The next Eimco would be something different again. A company where diversification, engineering capability, and operating leverage come together. That is the potential inflection point. And perhaps the most important line in the entire story is this. The transition does not become real when Eimco launches another machine. It becomes real when customers start ordering those machines at a scale that changes the company's financial trajectory. That is the moment to watch. Because if orders accelerate while margins remain high, Eimco can potentially transition from a niche mining equipment company to a diversified industrial growth story. And if that transition is followed by stronger cash generation and ROEs, the market may begin to see something even bigger. Not just growth, a re-rating. That is where the next chapter begins.